In this Goldbach teaching, I'm going to provide you with a complete guide to Goldbach Trading. There are three parts to this video where we discuss, firstly, the introduction to the foundations of Goldbach. We'll then go over a lot of key concepts to do with the algorithms and dealing ranges, and then we discuss advanced theories on time and liquidity. Now, Goldbach is a discovery by Hoppy. He was the originator of Goldbach, and if you want to learn more about Goldbach, there's a link to his official book in the description to this video. I've done this video in the form of a podcast. Hopefully this material will be more accessible than very technical charts. So sit back, listen, and let me know how you get on with these teachings.
All right, so you wanted the inside scoop on Goldbach Trading, and we got you covered. We took a deep dive into Aircam's guide, Goldbach Trading Unveiled. And let me tell you, this is not your typical market analysis.
It really challenges a lot of the conventional wisdom you hear about trading, especially when it comes to things like chart patterns.
Right, like forget your head and shoulders, triangles, all those classic shapes. Aircam basically says they're too subjective,
Yeah.
and they don't account for the bigger picture, something he calls algorithmic markets. What do you make of that?
Well, think about it. Aircam worked on the trading floor at Goldman Sachs and JP Morgan, so he's seen firsthand how these huge institutions use algorithms to execute trades. His theory is that these algorithms tend to revisit specific price levels, creating patterns that traditional chart analysis might miss.
Okay, so it's not just random market noise. There might be some rhyme and reason to those price swings.
Exactly, and that's where Goldbach Trading comes in. It's a framework built on the idea that price moves in a predictable way within specific ranges called dealing ranges. And get this, these ranges are determined by powers of 3.
Powers of 3, like 3, 9, 27. It feels a bit like numerology or something.
I know, it sounds kind of strange at first, but it's actually based on this idea of fractals, where patterns repeat themselves at different scales. So you might have a large dealing range based on 243 pips. And within that, you'd have smaller ranges based on 81, 27, 9, and so on.
So you could apply this to any time frame, whether you're scalping or swing trading.
Precisely. Now, inside each dealing range, you have this concept of premium and discount zones. Think of it like a line drawn right down the middle of the range. Anything above that line is premium, and anything below is discount. The idea is that prices oscillate between these zones and tend to gravitate back towards that middle line or equilibrium.
Instead of just looking at random support and resistance levels, we're looking at these mathematically defined zones within the dealing range. Interesting. But I have to ask, why powers of 3? It's not like I see the number 3 flashing on my charts.
Well, it's not about seeing the number 3 literally. It's more about how these numbers create that fractal structure we were talking about. The power of 3 sequence naturally creates nested ranges within ranges, which allows traders to analyze price action at different levels.
So it's less about the specific number itself and more about the relationship between those numbers and how they create this hierarchical structure.
Exactly. It's about seeing the market through a different lens, one that takes into account these underlying mathematical principles.
Okay, so we've got these dealing ranges with their premium and discount zones, all based on this fractal structure. What happens inside those ranges?
Well, that's where those algorithms we were talking about come in. Goldbach Trading identifies 2 main algorithms that describe how prices tend to move within those ranges.
Okay, let's unpack those algorithms.
Algorithm 1 is called low order block high. Imagine price starts at the low of the range, or at a point where it gets strongly rejected from going lower, called a rejection block. From there, price moves up to an order block, a specific type of candle formation, and then continues to the high of the range.
So it's like a roadmap for price action, driven by those algorithms strategically buying or selling at specific levels.
Exactly, and what's fascinating is that it's not just any down candle that can be considered an order block. It has to form within a specific order block partition of the dealing range.
So there's a lot more to it than meets the eye. It's not just about recognizing patterns, but understanding where those patterns occur within the larger structure of the dealing range.
Right, and now on to algorithm 2. This one follows a sequence of rejection block, breaker block, fair value gap, opposing order block.
All right, I'm all ears. Break that down for me. What are breaker blocks and fair value gaps?
So imagine the price bouncing off that rejection block like we talked about earlier. Then a candle or a group of candles forcefully break through a previous high or low. This is your breaker block. It's a signal that the market might be shifting gears and setting up for a bigger move.
So the breaker block tells us that something significant is happening, that the price is overcoming a previous level. What happens next?
Next, We often see a fair value gap, an empty space on the chart where the price has jumped up or down. But Goldbach emphasizes that not all gaps are created equal. True, fair value gaps form within a specific FVG partition of the dealing range, and these gaps act like magnets, drawing the price toward them.
So we're not just looking at random gaps, we're looking for gaps that form within those specific Goldbach zones.
Precisely. And finally, this sequence ends at an opposing order block. This is a potential turning point where the price is likely to reverse and head back towards the equilibrium of the dealing range.
Okay, so this algorithm is giving us a step-by-step way to analyze price action within the dealing range, from rejection block to fair value gap to opposing order block. This is starting to feel like a treasure map for traders, but, I have to be honest, this whole algorithmic market thing, is it really that predictable?
I know it can sound a little far-fetched, but if you think about it, large institutions have been using algorithms to trade for years, and those algorithms have to follow certain rules. Goldbach Trading is just trying to decode those rules and give individual traders a glimpse into how the market might be moving.
So, it's not about finding the holy grail, it's about understanding the underlying forces that might be driving these price movements.
Exactly. And even if you're skeptical about the whole algorithm thing, the principles of Goldbach Trading can still be valuable tools for analyzing price action and identifying potential trading setups.
Right, it's about adding another layer of analysis to our trading toolkit. So, we've got these dealing ranges, the premium and discount zones, and these two powerful algorithms. What's next? How do we actually use this information to trade?
Well, that's where things get really interesting. In the next part of our deep dive, we'll explore how to combine these Goldbach principles with other trading concepts like order blocks and fair value gaps to build a solid trading strategy.
That sounds great. We'll see you in part 2, where we'll continue unpacking this fascinating approach to the market. Welcome back. Last time, we laid the groundwork for Goldbach trading, those mysterious dealing ranges, the premium and discount zones, and the two key algorithms. Now let's see how those pieces fit together with familiar trading concepts like order blocks and fair value gaps.
What's fascinating is how Goldbach refines our understanding of these concepts. For example, a lot of traders think any down candle followed by an up move is an order block. But Aircam says, not so fast.
Yeah, that always felt a little too easy to me. So what makes a Goldbach-approved order block?
It's all about location. A true bullish order block in the Goldbach world has to form within the specific order block partition of the dealing range. It's like real estate. It's all about location, location, location.
So those Goldbach indicators we mentioned earlier come in handy here, helping us visualize those key zones within the range. So a down candle outside that partition might not be a significant order block.
Exactly. It could just be random noise or a temporary pullback. But a down candle forming within that order block partition, that's when things get interesting. That's when algorithm 1 potentially comes into play.
Right. The low order block high sequence, where algorithms might be driving the price up. So Goldbach gives us a way to filter out the noise and focus on the order blocks that really matter.
Precisely. And the same principle applies to fair value gaps. Many traders chase any gap they see. But Goldbach says, be careful. A true fair value gap has to form within the FVG partition of the dealing range.
So, just like order blocks, it's about context. A gap outside that specific zone might not have the same significance.
It might just be a liquidity void caused by thin trading or some news event. A true Goldbach fair value gap acts as a magnet, pulling the price toward it, often leading to those explosive moves we all dream of.
And remember how algorithm 2 utilizes those fair value gaps. Rejection block, breaker block, fair value gap, opposing order block. It's like a chain reaction leading to a potential reversal point.
Exactly. So by combining these concepts, we're not just chasing random gaps in candles. We're using the Goldbach framework to identify high probability setups that align with the underlying structure of the market.
This is really starting to make sense. It's like Goldbach gives us a whole new way to read the market's language.
And speaking of language, we've been focusing a lot on price, but Aircom also emphasizes the importance of incorporating time into our analysis.
Okay, this is where things start to get really mind-bending. Most trading approaches only look at price levels. How do we factor in time?
Well, think about it. Big market moves often happen around specific events or times of day, economic releases, opening bells, etc. Aircam argues that combining the right partition with the right time zone can lead to those powerful expansions and reversals.
So even if we have a perfect Goldbach setup in terms of price, if the timing is off, it might not work as expected.
Exactly. Time adds another layer of confirmation, increasing the probability of a successful trade.
This is fascinating. Are there any specific time-based techniques that Goldbach traders use?
One technique Aircam mentions is the 90-minute candle trick. It involves looking back at old 90-minute candles and seeing if their timestamps align with the current swing high or low, if they do. And it coincides with a key Goldbach partition. It could signal a high probability trade.
So we're not just looking at charts in a vacuum. We're considering the historical time cycles and how they might influence current price action.
Precisely. But even without getting into those advanced techniques, simply being aware of time as a factor can improve your trading. For example, knowing when liquidity tends to be thin or thick can help you avoid getting whipsawed by those sudden price spikes.
Right, so we've covered how Goldbach helps us understand order blocks, fair value gaps, and the role of time. Now let's get down to brass tacks. How do we actually build a trading strategy using all of this?
Aircams outlines a step-by-step approach in his guide. First, you need to establish your bias. Are we bullish or bearish on the market overall? But instead of relying on gut feeling or news headlines, Goldbach traders use those larger dealing ranges to determine the market's direction. Are we in a premium or discount zone on the daily or even monthly chart? That sets the stage for your trading decisions.
So we're looking at the big picture, not just what's happening on the 5-minute chart.
Exactly. Once you have your bias, you zoom in and look for setups that align with it. This is where those Goldbach algorithms come in. Are we seeing algorithm 1 in action, with price moving from low to high via an order block? Or are we seeing the rejection block, breaker block, fair value gap opposing order block sequence of algorithm 2?
We're essentially using the algorithms as a roadmap, filtering out setups that don't fit our overall bias.
And remember, it's not just about identifying the patterns themselves. It's about confirming that those patterns align with the correct Goldbach partitions within the dealing range. That's what gives you the edge.
We're not just blindly following any order block or fair value gap. We're being selective, only taking trades that meet the Goldbach criteria.
Precisely. And once you've identified a potential setup, it all comes down to risk management. One of the great things about trading within a defined dealing range is that you have a clear understanding of the potential risk and reward. You can place your stop loss beyond the dealing range boundary or at a key fractal partition, minimizing your losses.
So instead of using arbitrary stop loss levels, we're using the structure of the dealing range to guide our risk management decisions.
Exactly. And because you have a predefined range, you can set realistic profit targets. You're not just hoping for the price to go to the moon. You're aiming for specific levels within the dealing range that offer a favorable risk-to-reward ratio.
Okay, so to recap, we establish our market bias, identify setups that align with that bias and the Goldbach algorithms, and then manage our risk effectively using the structure of the dealing range. That's a solid foundation for a trading strategy.
It is, and the beauty of Goldbach is that it can be adapted to different trading styles and time frames, whether you're a scalper, a swing trader, or a long-term investor. These principles can enhance your decision-making process.
So it's not a one-size-fits-all approach. It's a framework that you can customize to your own preferences.
Exactly, and that's what makes it so powerful. It's not about giving you a set of rigid rules. It's about giving you a new lens through which to view the market.
It's like learning a new language, a language of the market's algorithms.
That's a great way to put it, and the more fluent you become in this language, the better equipped you'll be to navigate the complexities of the market.
So we've covered a lot of ground here, how Goldbach refines our understanding of order blocks, fair value gaps, and the role of time. And we've touched on how to build a trading strategy using these principles. But hold on tight, because in Part 3, we'll dive into some of the more advanced Goldbach concepts, like fractal mirroring and dynamic dealing ranges.
We'll also address some of the common mistakes that traders make and how to avoid those pitfalls. Don't miss it.
All right, welcome back for the grand finale of our Goldbach Trading Deep Dive. We've covered a lot of ground, from those intriguing dealing ranges to the power of those algorithms, but we saved the most mind-bending stuff for last. Fractal mirroring and dynamic dealing ranges. Ready to push the boundaries of market analysis.
Let's do it. Remember how we talked about the fractal nature of Goldbach, those nested dealing ranges within larger ranges? Well, fractal mirroring suggests that price movements within those ranges can sometimes mirror each other in a symmetrical way.
Okay, my brain's trying to picture this. So you're saying a pattern that plays out on a larger dealing range, say based on 243 pips, could be reflected on a smaller nested range, like one based on 81 pips.
Precisely. Imagine you see a strong rejection block forming at the low of that larger 243 pip range. Fractal mirroring suggests you might see similar rejection blocks forming at the lows of those 81 pip subranges. It's like those Russian nesting dolls. But for price action,
So it's not just about spotting individual patterns, it's about recognizing how those patterns repeat themselves at different scales. This is getting deep. Could this help us anticipate potential turning points?
Absolutely. Let's say you're watching that larger 243 pip range and see price bouncing off a bullish order block. If you then notice a similar bullish order block forming at the low of one of those 81 pip subranges, it could be a great entry point for a trade that aligns with the larger trend.
Wow, so fractal mirroring could give us an extra layer of confirmation, showing us that the same forces are at work across multiple time frames. This is way beyond just drawing trend lines on a chart. Okay, now on to dynamic dealing ranges. What makes these ranges dynamic?
Well, while those basic power of three dealing ranges provide a solid framework, markets aren't always perfectly predictable. Sometimes price breaks out of those initial ranges, but then fails to continue the move.
Ah, those pesky false breakouts. So what happens to our dealing range in those situations? Does it just become invalid?
Not necessarily. Instead of completely invalidating the range, Aircam suggests that these failed breakouts often cause the range to shift. He calls it a half shift, where the range adjusts by half of its original size. It's like the market is recalibrating, finding a new equilibrium after that failed breakout attempt.
So our dealing range isn't static. It can adapt to the market's movements. But how do we know when a shift is happening? Are there any warning signs?
Aircam outlines a few clues. One is a strong rejection at the extension of the initial range. Remember those extensions we talked about, those outer limits where price often makes sharp moves to sweep liquidity? If price pushes beyond the extension, but then gets forcefully rejected, it could signal a potential shift in the dealing range.
So it's like the market is testing the waters, seeing if it can break free from that initial range, but then gets pulled back in. What other signs should we look for?
Another clue is a failure to establish a new higher low beyond the initial range. If price breaks out, but then stalls, unable to make a sustained move, it might be a sign that the range is about to adjust.
Okay, so those failed breakouts and rejections are key signals to watch for. But once a dealing range shifts, how do we adjust our trading approach? Do we just redraw the entire range?
Exactly. You essentially redraw your dealing range based on the new higher low that's been established, all those partitions, equilibrium lines, everything gets recalibrated based on that new range.
So it's like we're updating our map to reflect the changing terrain of the market. This takes adaptability to a whole new level.
It definitely does, and that's what separates skilled Goldbach traders from the rest. It's not just about memorizing patterns, it's about understanding how those patterns can shift and evolve over time.
This is pretty mind-blowing stuff, but before we wrap up, I think it's important to talk about some of the common pitfalls that traders might encounter when applying these Goldbach principles. After all, we don't want our listeners getting lost in the matrix.
You're absolutely right. One of the biggest mistakes is misidentifying those order blocks. Remember, not every down candle is a true order block in the Goldbach framework. It has to form within that specific order block partition.
So we need to be very careful and double-check those partitions before jumping into a trade, not just blindly buy every time we see a down candle. What other traps should we be aware of?
Another common mistake is chasing those fake fair value gaps. Remember, location is key. If a gap doesn't form within the FVG partition, it might not have the same significance for Goldbach trading.
We're not just blindly filling every gap on the chart. We're looking for those gaps that align with the Goldbach structure.
Exactly. And finally, one of the most common mistakes I see is overtrading or forcing setups. Remember, patience is a virtue in trading. Not every price movement needs to be traded.
Right. Sometimes the best trade is no trade at all. We need to wait for those high probability setups that align with our bias, those algorithms, and the overall Goldbach structure.
Precisely. It's about quality over quantity, waiting for those moments when all the stars align.
Well, folks, that brings us to the end of our Goldbach Trading Deep Dive. We've journeyed from the basics all the way to those advanced concepts like fractal mirroring and dynamic dealing ranges. It's been quite the adventure.
You've now got a solid understanding of this powerful framework for analyzing the market. But remember, this is just the beginning. The real learning comes from applying these principles, experimenting, and refining your approach over time.
Exactly. Aircam's guide is a great starting point, but it's up to each individual trader to take this knowledge and make it their own. So keep exploring, keep challenging your assumptions, and never stop learning.
And who knows, maybe you'll uncover some hidden patterns and insights that haven't even been discovered yet. The market is a vast and ever-changing landscape, and with the right tools and mindset, the possibilities are endless.
That's a wrap on this Goldbach Trading Deep Dive. Thanks for joining us on the Deep Dive, and we'll see you next time for another fascinating exploration.